So we've been in West Chicago replacing dock shelters with brand spanking new ones, and I did something today I really hate having to do. I had to kill some wasps. Now it may not sound like a big deal to you, but I take a different approach in that we are all on this spinning blue ball. We're DNA that's just trying to survive. I'm made of DNA, you're made of DNA, and these poor wasps are made of DNA. But had to be done. Customer paid us to have these brand new shelters put up, and I had to kill the wasps. Now I did this with brake parts cleaner because it kills them so quickly in about 15 seconds, knocks them down, and I like to think that they feel a state of euphoria before it shuts down their little beating hearts. So this made me reflect and think that life is so short and we don't know when our number is up. Now, as investors, we can get caught up always looking into the future and understanding that a dollar is worth more today than it is tomorrow. But also don't forget that you will never be as young again as you are right this very second. So we have to have a balance between planning and investing for the future, but also living now because we just don't know when our time is up. So please, I implore you, don't let these poor little wasps' lives have been lost in vain. Understand that you have to plan for the future, but you also have to enjoy today. Hey, what's up? I'm Russ, and this is Dapper Dividends, where we're helping you grow your net worth by sharing what we're doing to grow our net worth. And the ultimate goal is to one day make work optional when you can do what you want to do instead of what you have to do. Inflation is defined as a general increase in prices and a fall in the purchasing value of money. Now, checking out this chart from usinflationcalculator.com, we see that in 2021, inflation has exploded to 5.4% from 1.4%. It's undeniable that inflation is here. So how are we going to protect our assets and continue to grow our assets in periods when everything is more expensive? So we're looking for stores of value and to put our money with entities that are able to increase their prices. And when they raise the prices on their goods and services, they are able to pass those on to the consumers. This Bank of America article shows that going back to 1961, inflation between 1.5 and 2.5%, the S&P 500 returns an average of more than 15% gains the following year. But lower inflation of 0.5% to 1.5% produced returns averaging less than 7% the following year. And we've already had companies confirm that we're in an inflationary period like Procter & Gamble, PepsiCo, and General Mills, to name a few, that have already said they will be raising their prices because of the increased cost of goods. Now, this is why some equities, some stocks are good hedges against inflation, because higher inflation boosts the nominal economic growth, which results in higher earnings, and the higher earnings should result in higher stock prices. So the first place that we're putting our money is into equities. And this chart from Fidelity shows that the last 4 trough to peak inflationary cycles, energy, utilities, and materials performed the best, while banks, consumer staples, and financials were the worst performers, with the S&P 500 gaining 13%. Now, we say it here over and over that good companies are good companies no matter the economy. And if they are down because of an inflationary cycle, that is a fantastic time to buy these great companies at discount, unless you are living on a fixed income and you're having to sell your investments for current income. Now, this is something that we're trying to beat by investing in dividend growth companies, because one day we plan to live off of the dividend income, meaning that we will hopefully never have to touch the principal and we can live off of the interest from the dividends. So we're buying companies with pricing power that they can raise the prices when people will continue to buy. Now, this is one thing that I found, that consumer discretionary stocks tend to outperform the consumer staples. Is this again chart from Fidelity shows that wage growth increases cyclicals odds to outperform. So consumer cyclicals or consumer discretionary, think stocks like Nike, like Home Depot, like Lowe's, or like Starbucks or McDonald's. One of the other sectors we talked about were energy. Now, energy has been on a bit of a bull run because of higher prices in the oil sector, and they have also, energy companies, check this out again from Fidelity, they have slashed their spending, and when we couple that with the higher prices, the energy sector has a growing free cash flow, which is great for two companies that I love to invest in, and I love them because they're vertically integrated, meaning that they are involved in the upstream, midstream, and downstream process. Those would be Chevron, ticker CVX, and ExxonMobil, ticker XOM. And by the way, at one point, ExxonMobil was the #1 producer of natural gas. And another sector that does well is materials. Think companies like United States Steel, ticker X, or Southern Copper Corp, ticker SCCO, and one of my favorites, LyondellBasell, ticker LYB, and we can also lump in their ag products and ag companies like Mosaic, ticker MOS, is chemicals that go into the fertilizers, companies like Archer Daniels Midland that are growing the food that companies buy to produce into what we buy and sustain us through the year. And also raw assets, which are a good hedge against inflation. One company that comes to mind is Catchmark Realty, ticker CTT. Now this is a timber REIT, but one thing to always keep in mind with the commodities is that they are subject to supply and demand. So as we saw with oil and we see with other commodities, when there's low demand and high supply, prices are going to come right back down. Secondly, we also like gold. Now, I had to learn a bit of a lesson with gold. Coming out of the 08-09 recession, I stupidly sold a chunk of the 401k and bought precious metals that I kept in the house. Now, the problem with gold and precious metals is that they are a store of value, but not a very good hedge against inflation because they kind of keep pace with inflation on a 1-to-1 ratio, but they don't produce any income and they don't grow in multiples of inflation. So we own companies that mine the gold because when gold goes up, the gold miners also go up. One of our favorites is Barrick Gold, ticker GOLD. And we can't talk about gold without mentioning the digital gold in Bitcoin, which is our #3 hedge against inflation. What we love about Bitcoin is that it is limited in supply, and we know that there will only ever be 21 million Bitcoin. And check out this little graphic I found that shows that there are currently about 20 million millionaires in the world, meaning that there is not even one Bitcoin for every millionaire. So when mass adoption, if it happens, which eventually I think it will, I don't know if it'll be in my lifetime, but someday I believe digital currency is going to be adopted by the masses. And when it does, look out, we'll be talking about not the price of a Bitcoin, but the price of a Satoshi, which also known as sats, is a super fractionalized part of a Bitcoin that can be traded, it can be stored. Bitcoin is infinitely more fractionizable. Is that a word? Fractionizable. I just made up a word here. Than physical gold is. It can be transferred much more easily. You don't need a third-party intermediary. You don't need banks. We love Bitcoin, but we also think there's a place for physical gold. We are not Bitcoin or gold maximalists, but we are trying to grow our net worth and preserve some of our assets. So we will continue to buy both and go for the gold. And #4 is real estate, in particular, income producing real estate that we access through REITs, through real estate investment trusts. They required by law to pay out 90% of their profit in the form of a dividend. And what's great about real estate is that the property value will rise with inflation, but when we have income producing real estate, they will also be able to raise the rent with inflation. So we think of companies we love like Realty Income, like Stag Industrial, but real estate is a fantastic hedge against inflation and a store of value and something that will also produce an income. And as always, we recommend holding REITs inside of a tax-advantaged account because REIT dividends are non-qualified, meaning you will pay your ordinary income tax rate on the dividends, but if they're held inside of a tax-advantaged account like a Roth or a 401k, you will not pay income tax on those quarterly dividends, and you will only pay capital gains tax when you withdraw them unless it's in a Roth. So those are some of the ways that we're trying to hedge inflation and also outpace inflation. Let us know what some of the ways are that you are trying to outpace and hedge inflation. And one company we're not doing it with is General Electric. Check out why in this video here, and we will talk to you there.